Good afternoon, ladies and gentlemen. Welcome to the Barometer Readings monthly conference call. At this time, all participants are in a listen-only mode. Following the presentation, we will conduct a question-and-answer session, at which time instructions will be provided. For operator assistance during this call, please press star, then 0. I would now like to turn the meeting over to Nick Hamilton. Please go ahead, Mr. Hamilton.
Thanks, operator. Hi, everybody. Welcome to the Barometer Readings monthly conference call. So on the call, as always, to provide a detailed update is David Burrows, our President and Chief Investment Strategist. So clearly now, holidays are a distant memory. January weather is less than hospitable. It's minus 20 here in Toronto. But it is January. It is a new year, and as the saying goes, with a new year brings new opportunity. So over the last number of calls, we've spent considerable time discussing a market in transition, and this is certainly true in the income arena with rising yields in 2013, but also the broad equity space, which continues to demonstrate clear pockets of strength and weakness, as well as following correlations. As many of you know, our disciplined leadership approach plays very close attention to market leadership and opportunities for investors to participate in areas of the market that are the most constructive. In our view, it's clear that the transition we've witnessed across a range of geographies, sectors, asset classes over the last 18 months has created new opportunities for investors. This environment is ideal, it should be said, for the Barometer approach, which is all about recognizing change and tactically adjusting portfolios, but always keeping a focus on leading securities in leading markets. So among the strategies we offer to advisors, we continue to emphasize the appeal of our income strategy as a core, and we'll revisit the case for that today. What we're also building awareness about, however, is a new Go Anywhere equity fund, which will have added flexibility to benefit from an increasingly constructive equity market. So to help paint a full picture of that, I'll turn it over to Dave.
Great. So thanks, folks. Thanks for taking the time today. It's great to get a chance to touch base with everybody. Here we are at the beginning of the year. It's been an interesting 12 months we've just been through. What I thought I'd do is just give a real quick review as to what we've been seeing going on out there and what we're doing in the portfolios. It was a good year. It was interesting. We were going back over our quarterly commentaries, and I think in the first quarter of last year, our graphics guy did a very interesting stylized bull standing on 4 pillars as we were making the case that it looked like the market was in transition, that correlations were starting to come down, and there were some pretty clear themes starting to come forward. And just to revisit, I think that one of the reasons that folks use our mandate is because it can go anywhere. We really have no particular biases. And we just use these top-down models to try and identify where the money's going next and then focus in those areas so long as they continue to work. The period between 2000 and 2012 was a tough period because while if you were active and you could pick your spots, you could generate some total return. I think the income strategy had about 366% total return over the period of the 12 years where you took $1 million and put 70% in the TSX and 30% in the S&P, you made about 50% cumulative. So it worked quite well. The frustration through that period was, though, that in general, leadership themes came and went fairly rapidly. There was a lot of turnover in the portfolios, and we really had to work our way through it. Coming off the lows in 2008-9, there was some quite clear trends that emerged. One of them was a yield-driven theme. In 2001, when the bull market rolled over, we came to a view that straight equities were probably going to be a tough road to hoe, and we needed more tools. We set up the high-income mandate. And when we did that, it was always in our mind that while there could be times that we wanted to own a lot of fixed income, there may also be times we wanted things like dividend-paying equities and trusts so that we could work our way through rising and falling rate environments. And largely, over the 12 years, we were in a falling rate environment, and that was a nice tailwind. It's interesting how, November or October of 2012, we got to a point where people were so comfortable buying treasuries with a 1.5% yields attached, because, of course, fixed income had done so well. And that posed a big problem for a lot of investors last year as rates started to rise a little bit, and actually, of course, the 10-year went from 1.5 to 3, and in the process roiled a bunch of portfolios that people thought were quite conservative. It was an interesting year for us last year because up to November of 2012, the 3 or 4 years prior, it had been a great place to be in interest rate proxies, corporate debt, REITs, pipes, telcos, things that were very low economic sensitivity but very predictable, that had a little bit of dividend growth. That worked great until rates started to rise. And in January of 2013, we started to see pretty broad deterioration in our breadth models and REITs, and at the same time, pretty significant improvement in breadth in financials. First of all, in banks, which wound up, populating the portfolios. I think we took our REIT exposure down by about a half in the first 3 months of last year, the corporate exposure down by about a half, and wound up building about a 30% weight in financials. Now, the market was going through lots of stuff back and forth over, potential tapering and rate increases and so on. But interestingly, by summer, the utilities and the telcos had backed up, and other groups like consumer discretionary and media really started to pick up the slack. By the fall this year, things continued to get more constructive at the asset class level from an equity perspective. From a sector perspective, leadership continued to shift towards things that were a little more economically sensitive. And when finally the U.S. debt issue, the debt ceiling issue, got pushed back in October, after a very small correction of about 3%, all of that economically sensitive stuff started to rally, and fourth quarter wound up being a very productive quarter. So ultimately, those little incremental shifts took us from a portfolio that was extremely conservative and very low economic sensitivity to a portfolio that was 95% stocks, highly dividend growth focused, much more economically sensitive. And in a year where, 10-year yields doubled, we were really happy in that new fund to be up sort of 13, 14% on the year. But it speaks to the fact that we're fortunate that we have a mandate that lets us do that. On the equity side, it was quite similar. Now, there's only so much you can do on the income side, only so many sectors really you can participate in if you do have a cash flow expectation. We were, overwhelmingly happy that 94% of the holdings we had in the income portfolio gave us dividend increases of anywhere from 3 to 35%, which is ultimately what let us fight those rising rates, and left us in a really good stead. Just before I go on to equities, the one thing I do want to highlight is while we did see rates go from 1.5 to 3, we continue to think that going forward from here, we are unlikely to see a further move of like 3 to 5% on a 10-year. It just appears that the lack of inflation and the lack of significant employment growth and the relatively muted growth levels in the economy, and I guess finally the very low indication of credit risk that we see in the credit default market, we think it's very unlikely that without any of those significant things, rates move much higher. So if we think that rates move sideways from here or slowly rise, we think we face far less headwind this year in an income strategy than we did last year. If equities continue to be constructive, this is where we are, right? We're in equities. We're getting a nice dividend yield. We are getting very good dividend growth. And you've all seen us walk through the dividend payout slide. After dividend payouts rising a little over the last couple of years, interestingly, earnings rose enough last year to offset the increase in dividend payments, and we're still only getting about a 32% payout out of the S&P against the long-run average of 50, and peak cycle payouts of like 70%. So we still think there is significant dividend growth to be had over the course of this next year. So before Christmas, we cited some statistics on one of the large U.S. bulge bracket investment dealers where their client base, of about $1.8 trillion, I think it was Morgan Stanley, had something like 12% in short-term deposits, 18% if you included, 12% cash, 18% if you included short-term deposits, and just over 50% in bonds. If that money starts to move towards equities, it's probably a lot of it going to move through the dividend growth camp before it goes further out on the risk curve, which means that we probably have a pretty constructive environment going forward. The Income Advantage Fund, which we really appreciate, people participated in over the last year, and we're glad it worked out well. The income pool that we manage, same way, comes out of last year with like 23-24% financials, and that would be made up of banks, but more economically sensitive than that, asset managers and insurance companies. These conditions bode well for them. Energy infrastructure is still there, but then you go down the list, and we do have industrial exposure. We do have a little bit of technology exposure. We have a little bit of chemicals exposure, things that are more economically sensitive that can give us some pretty good growth and good U.S. exposure. So quite bullish for this year relative to last year on the income strategy. But having said that, we said at the beginning we are in a market that's transitioning, and there are other significant parts of the equity markets that are behaving really well that are probably less likely to wind their way into the high-income portfolio. And so we have spent quite a bit of time over the last while highlighting equity markets and our equity strategy, really for the first time in about 12 years. We came with that income strategy in 2001. We thought it was timely for a lot of reasons. We think that straight equity strategies have become very timely now and have a good runway in front of them, and I'm going to talk through that case right now. But in general, if you look at what worked over the course of last year, outside of financials, consumer discretionary was very strong leadership. Healthcare was very strong leadership. Technology, very strong leadership. And industrials. So those groups, those five groups, really are what made up leadership in U.S. markets in the 1990s. And they are all sectors that benefit from a weaker inflation environment and in an environment where the consumer is a little bit stronger. Now, that means that we got to look outside of Canada, and as you know, we have been. It's interesting. We get all kinds of questions. Why is it Canada so underperformed last year relative to the U.S. and Canada's up 7 or 8%? Just take a walk through the makeup of the index. Technology in Canada 1.6%, in the U.S. 18. Healthcare in Canada 2.8% versus 13 in the S&P. Consumer discretionary about 5% in the TSX, 12.5% in the S&P. And industrials, make up only 7% of the Canadian market, where it's about 11% in the U.S. So, take those sectors, which really were the leadership in the market. Canada just does not have a significant weighting there. So that's kind of an issue. We came out of the year with the equity pool very focused in the U.S. About 70% of the portfolio in the U.S. The 30% that was in Canada, interestingly enough, is largely in situations that benefit from a weakening dollar. So it's not so much a call in the Canadian market, but actually an attempt to take advantage of a weakening dollar. Biggest weightings in the group would be consumer discretionary, internet-related securities, about 18% of the portfolio. Consumer cyclical, about 15%. Biotech in the healthcare group, about 8%. Gaming, again, consumer-driven, about 6%. Software, about 6%. Industrials, you've got airline and airplane parts, a significant portion of the portfolio. Semiconductors, very different portfolio than we entered last year. It's a couple of other ways to slice it up. About 30% of the portfolio would be what we would call small to mid-cap securities. When I say small cap, I'm talking about billion-dollar-plus market caps in the U.S., but they are small relative to very large caps. Those companies tend to be more focused on the domestic economy, less dependent on strong global growth, and very, very, very focused in North America. You can really see our top-down view when you take a look at the makeup of the ETF pool, which had quite a good year. The biggest weights, 25% industrials, 23% technology, 17% financials, 15% consumer discretionary, and 14% healthcare. Those are the big sector weights, all of them U.S.-based. Developed markets in Europe make up about 12% of the portfolio. And on the other side, actually short commodities, emerging markets, both Latin America and Asia, and some currencies against the dollar, so very dollar-centric. So let me make the case as to why it is that we think that this year shapes up pretty well, despite the fact that last year was very good. I think all of us over the last few years have gotten used to the idea you get a good year, you better put your helmet on because it's likely to get tougher the next year. We think it's actually quite different at this point. When we look at our basic indicators, those bullish percent indicators, the percent of stocks that are performing well at any given time, on a global basis, 56% of stocks globally are performing in a constructive price behavior. So why is that relevant? First of all, it's been rising steadily since June. So bullish percent has been improving, meaning a higher and higher percentage of stocks in the market are participating. But at 56%, we are a long way from 70 or 80% of stocks, which is where we tend to peak out in significant rallies. So we hear discussion around the concept of a bubble in equities, but breadth is nowhere near those levels you would call it a bubble. In fact, it actually highlights the fact that it really is a have and have-not market. Certain stocks are doing well, lots aren't. You just got to find your way to the right spots. But globally, 56% of stocks are improving. In fact, all of our short-term indicators, there's 4 of them, are showing slow improvement. There are no major cracks in any of our indicators. And even if we were to get to 70%, breadth can get to 70%, meaning 70% of stocks are performing well, and then stay there for a year at a time. The higher the breadth goes, the more inclusive the rally becomes, and the more productive it is to be invested. So from a breadth perspective, we are seeing steady improvement. Now, it depends market to market. S&P clearly was the best market globally last year of the major markets. Europe was up about 12%, TSX up 7-8%, and a lot of the emerging or developing markets were negative. If we look at the breakout country to country, the broadest rallies, where between 58 and 65% of stocks were doing well, occurred in developed markets. So ending this most recent week, in that category, I'd put London, I'd put Germany, the DAX, I'd put actually most of Europe, the U.S., and Canada. At the other end of the spectrum, countries where you're getting mixed price behavior, where breadth, some are up and some are down, but much narrower rallies, would be the developing markets, Thailand, Brazil, Singapore, most of Latin America, India, and of course China. So very clearly, based on our work, we are in a market where it's about developed markets, not developing markets. Now, our mandate lets us go anywhere, but as you can see right now, we are highly focused in developed markets, which raises an interesting issue. Over time, there's a very high correlation between emerging markets behavior and commodity markets. When growth is strong in emerging markets, it tends to be commodity demand is strong, and they tend to often have coincident rallies. And when commodity cycle rolls over, it often is coincident with a rollover in emerging markets, which of course happened in 2011. Emerging markets started to underperform, commodities started to underperform, which is one of the reasons why we've been very cautious on Canadian dollar. So, how long can that continue for? We've got an interesting chart, and you may want to get a copy of it from Nick or from Sarah, that takes a look at each of the major developed countries and in which year their spending on capital investments peaked as a percentage of their GDP. So, for instance, in Canada in 1966, our peak of spending on capital spending was 26% of the economy. The U.S. peaked in 1979 at 22%. Germany peaked in 1970 at 30%. China this past year spent 48% of GDP on fixed investment, which is way above any other country ever, and certainly way above the peak in any other country. Now, they are openly saying they want to reduce investment on spending on fixed investments, and they want to refocus the economy on the consumer. If that's the case, it's hard to see how we get a commodity cycle. So that can come down a long way. So China clearly is a little off the boil. Commodities clearly a little off the boil. Canadian dollar in real difficulty. Australian dollar and Canadian dollar. So we think that is likely to continue. From a valuation standpoint, earnings yield in the S&P is about 7%. You compare that versus a 10-year bond at 2.8%. We're getting paid almost a 400 basis point risk premium to buy equities. So from a valuation perspective, not expensive. We're getting paid to take the risk. From a breadth perspective, solidly at midfield but improving. The things that could derail that, a sharply higher interest rate, but that's unlikely unless we think there's inflation in the system, and clearly there's not. Commodity prices are coming off. As oil production has been booming in the U.S., we've just printed a year where we've produced more oil in the U.S. than in any year in the last 30. That's finding its way into the refiners, and gasoline prices have been falling. Every 10-cent decline in the price of gas is like a $13 billion tax cut. So you're pushing money into the consumer's hands. So not only have they had their debt servicing costs come down as rates move lower and their savings rate moved higher, but the food and energy costs have come down, and that translates into a new high for consumer free cash flow. When we look outside of commodities, all of the indications of inflation continue to move down. Bank of Canada made reference to it today, that clearly one of the risks is weaker inflation. And they really, I believe, pushed out and became more dovish today, pushed out the possibility of higher rates, saying that it was going to be dependent on economic activity, and had much more dovish comments. I think that had a big impact on the Canadian dollar today. So if the consumer's balance sheet's in better shape and the consumer cash flow is in better shape, it's important because another chart that we have that we're using in our presentations right now shows overlays consumer spending as a percent of total spending versus the S&P PE. And there's a very tight correlation. As consumer spending moves up, historically, the PE of the S&P moves its way higher. So we got 3 multiple point expansions last year, an expansion of 3 multiple points. And I think a lot of people are concerned about the fact that the PE went up by 3 multiple points, and what does that all mean? Well, all I can say is that historically, there's 3 times in 50 years where that happened. All 3 happened in secular bull markets. So through the 90s, in 8 out of 10 years, you had multiple expansion. After 2000, in that decade, no years of multiple expansion. We've just seen a big multiple expansion in 1 year. In each of the 3 years this happened in the last 50 years, the following year was a strong equity year, a follow-through year. And actually, in 2 of the 3 occurrences, the 3rd year was a strong positive year. So not to say that that means that's what has to happen, but the precedent is that when you start to see multiple expansion, it continues. So long-run multiple for the S&P has been around 15 times. Through the 80s and the 90s, the multiple expanded from around 7 times to, well, at a peak about 25 times in 2000. Alan Greenspan talked about irrational exuberance in 1996. The market rallied for another 4 years. So we've just really had the first big year of multiple expansion since the PE contracted all the way through the 2000s. I think it's very early to say that PE expansion is done. I think it's more likely the beginning. Through the 90s, inflation dropped steadily and the multiple in the market expanded. From 2000 to 2012, market PE tightly tracked inflation levels. As cyclicals ruled the market, it was a risk-on, risk-off market. And about 14 months ago, inflation started to fall again, PE started to expand. It looks to us like we're in a new secular bull market for stocks, and there's room to move. Correlations are coming down nicely, as they tend to do in a bull market. In the 1990s, they started with correlations around 90% in 1991 at the end of that recession. By the end of the 90s, correlations were down below 30%. We started at 95% last October. We're sitting at about 55% today. Correlations can continue to come down. Again, very important if you're a manager that targets very specific themes. Low correlations provide opportunity to get targeted in that value, and that certainly helped us over the past year. The last data point I want to give you as to why I think that there's a good chance we have a long way to go here is that if you look at share ownership in private investors, at the end of the secular bear market in 1945, household ownership of shares was about 14% of net worth. And over the next number of years, until the market peaked in 1966, 20 years later, household ownership of shares worked its way up to just under 30%. From 1966 through 82, in the next secular bear market, household ownership of shares worked their way down to 9% of net worth and troughed out not far from where they did in 1945. And through the 80s and the 90s, slowly were rebuilt until by 1999, again, 29% of household net worth. So in 2009, we hit 11%. We're sitting at 19% today. It takes money working its way into the market to move prices higher. We're seeing that, but we are a long way, I think, from investors being invested. I think that psychology takes a long time to shift, so this could go on for quite some time. So I think most of you know we've shown a long-term chart of the Dow back to the 1800s for 12, 13 years now. And our comment was that, anyone can make money in a bull market, long-term secular bull market. It really is somewhat more problematic than a secular bear market, but our clients, of course, expect us to make money in both. The case that we've been making, and the reason we pushed so hard on the income strategy over the last 12 years, is that in a secular bear market, great to have a cash flow, and we all have to get the clients to the end of those sideways periods intact and with their psychologies supportive of having some risk, so you could take advantage of the bull market in stocks when it comes. And over that last 12 or 13 years, I guess 12-year period, we had a very strong cumulative return in the income mandate. It worked out very well. So we've been making the case for the last few months now that we do believe we're in a new secular bull market for stocks. Every time in the last 100 years when you came out of those sideways markets to the upside, you were into a multi-year secular bull market. And after trading sideways from 2000 through 2012, about 8-9 months ago, S&P broke above the high of the range. It has continued to march its way higher. The pullbacks, when they come, and they're inevitable, have been much more shallow than we've seen over the last 12, 13 years. Share ownership is low. Valuations are reasonable. Bullish percent is in the middle of the range. And I think the easiest thing to do is to get too cautious at this point. So we would make the case that we have moved into a paper asset cycle. We've gone to all of our large families that we take care of to suggest weighting up the equity component in their portfolios. And just like in 2001 when we launched the income portfolio, we're launching an equity prospectus fund to use with our advisors to try and make it easy. But we do think it's time really to consider it. As correlations fell in the 90s in our separate accounts, we had a very good experience, close to double the return we've had over the last 10 years. We'll have to see how things go going forwards, but this does appear to be the type of market that works extremely well for our strategy. We're always going to use the defensive tools that we have in the event that we need to use them, and there will be times, I'm sure. But on the other side, the value of being able to target leadership when you get sustainable themes gives you an opportunity to make real money when there's longevity in the rallies, and we think we're there. So the last thing I'll just highlight is that there's an excellent chart that we got from Mark Derry at Cormark, and I'll give him the credit on it. We get a lot of questions about gold and commodities in general. He showed us a great chart that showed a relative price performance of the Dow versus gold over the last 12 years. And, of course, from 2000 to 2012, the Dow way underperformed gold, so it's a relative downtrend against gold, until about 6 months ago when it crisscrossed and has turned the corner and stocks have started to outperform gold. That has happened 3 times in the last 100 years. The first time it happened was as the market turned positive in 1945, the beginning of a close to 20-year secular bull market. The second time in the century it happened was in 1982, of course, the beginning of the 18-year bull market that led to 2000, and this past year. So we think that evidence would support the possibility that we are in a new long-term bull market for stocks. We're there in our income portfolios. We are 95% equities and focused on dividend growth. We do think that there is opportunity beyond just the income camp to take advantage of equities and the relative valuation, and that's why we're coming with the equity product. So hopefully ultimately it will be useful. We'll spend more time on follow-up calls on specific names. I thought this was an important sort of macro discussion to have today. If anybody likes supporting charts, certainly Nick and Sarah can provide them to you, and we're certainly happy to answer any questions, but we appreciate you taking the time. I'm going to pass it back to Nick.
Yeah, great. Thanks, Dave. Just a few things before Q&A. So I think the quick summary is that we continue to observe a market in transition. We continue to manage our investors' exposure accordingly, and this is true on our income strategy as well as equity. The Barometer discipline leadership approach is very well suited to the environment we're in, always placing an emphasis on leading securities and leading markets and sectors, but with a process that's built to protect investors if breadth deteriorates. If we look at 2013, we're really quite pleased with our results as our income fund, which faced headwinds from rising rates, finished up the year 14.3%. And we've added to that in January, up over 3% for 2014 as of the end of today. For equity investors looking for the broadest opportunity set, we'd suggest taking a close look at our new equity fund. It's $5 million in size, and it's allocated to our best equity ideas. Our equity results for 2013 really reaffirm having a closer look with our private pool equity mandates up as anywhere from 26 to 28%. Very lastly, before Q&A, we have written a really good synopsis and outlook piece that I'd want to draw your attention to. It was sent out in our weekly holdings email this week. It contains a lot of the charts we've been working with to kind of convey our view on strategy and comments as well that reinforce the themes we've discussed today. It'd be a powerful tool to use with clients and explain some of the shifts we've seen, continue to see, and we also have the full Q4 commentary available. So with that, we'll open it up to Q&A.